Good morning. Welcome beyond the SEAF model. I'm Jack Kosar. This is effective for the week of January 26, 2026. Let's get started. SEAF signals for this week. We have energy, healthcare, and financials. Financials coming off the bottom into the top three. We'll go in a little bit more detail later as to why that is and what we believe the overall narrative is for sector rotation. In just a minute. Energy showing some real strength here. Ranking up at 5. That's an upper favored ranking for energy and showing strength across all three time periods. Healthcare being led by its strategic quarter, but still showing some overall strength here in the tactical and trading trading week and tactical month. Sorry, I get a little tongue-tied here. Technology down here at the bottom with the overall worst score you can have with 11s across the board. Going into our heat map. So seeing some strength in energy and financials really being kind of run up here on this trading week. 0.31, not quite that 0.4 number that we're looking for, but really being pushed around here on the trading week, showing little to no asset flow on the tactical month of strategic quarter, being very much near zero, but better ranking than the 6 or 7 that are below it here as assets have been flowing out. It was a very unique week. Tuesday opened up last week with outflows of near, negative 1.34% across the entire board. So money really flowing out of the 11 sector spiders to all but get rebounded on Wednesday at 1.76. But what we did see here is it wasn't an asymmetric in and out. Money flowed out and then came back in really over only 3 sectors here. Communication services being here net almost zero on the trading week. So money flowed out pretty aggressively from the S&P 500 on Tuesday and then asymmetrically flowed back in really toward these top 3. Very much seeing not a lot of asset movement or flows here in the bottom half of this table. And what I was wanted to show is financials and what kind of happened. How do we go from deep avoid to all the way into favored in 1 week? And it was kind of a series of multiple factors here. One, going back into September of last year, we had some really strong outflows that took it from a favored into a void relatively quickly, and that resulted in a strong relative underperformance versus SPY. Some of those outflows dropped off, leaving financials kind of more of at a net zero here from going back in the quarter. In terms of any accumulation over the 3-month time period that we track the asset flows. That in coordination with the fact that a good chunk of these sectors have been relatively unchanged. While we are red here through 6 through 11, most of this is very close to zero. We're just not getting a lot of accumulation over time periods. And what we really kind of want to point out here is, so what I have here is this is the sector ETF Asset Flow model, our SEAF model going back in the 12 months, just tracking the percent of flows invested in the sectors. And what we're seeing here is a real flattening of these sectors. What is that saying? Money is flowing in to the 11 sector spiders. We can see that through our sector spider total AUM. We have an upward positive trending sector, but the money is coming in proportional to the percent of assets invested in. So if you think of it as a pie, the slice of each pie is part of the, technology is a slice of that pie. We are seeing an immense flattening of that piece. So what is that telling us? Investors are not overweighting or significantly underweighting a lot of these sectors as they're moving through. So we can have a situation like financials where a little bit of money, 0.31 is not a significant amount in terms of how we track the asset flows in that trading week, really isn't moving the needle. Investors seemingly are nervous when it comes to trying to take in these oversized bets. And financials is a really good example of why. this, we were starting to trend positively up in financials. And again, I'm not making a political statement here, but over a weekend, a tweet suggests that credit card debt could be capped at a 10%. I'm not sitting here saying that's good or bad. All I'm saying is over the weekend, a tweet from the government tells us that they're going to try to cap interest rates on credit cards. What does that do? That money flows right back out. And then the minute the market has a chance to digest it, or another tweet goes out saying that you can pay your way out of not having to have 10%, or the financial companies figure out a way to override this, money can kind of flow right back in. Due to that, I think that really unstableness, it's causing this flatness. The money's flowing in. The train ride hasn't stopped. The S&P 500 is still nearing fresh all-time highs, but that money is just coming into the sectors proportionally. Now, the SEAF model is doing a good job in terms of finding where, industrials is a good one, finding where that money is slightly coming in faster than the other sectors, but we're really not getting a runaway. And the point I'm trying to make is this is that same chart where I'm going the percentage of money invested in the S&P 500 in the 11 sector spiders. It's normally a lot more jumpy. There's a lot more bet taking going on. Investors feel a lot more comfortable that they can go in and make sector bets based on, whatever their indicators are. If they're a fundamental investor thinking that money is going to start flowing into technology due to AI, if they are, a technical investor trying to pick out, trends and things of that nature. But where we normally see a lot more aggression in terms of the sector bets, where money is flowing between these sectors a lot more freely, and you can see investors taking a lot more outsized bets on what sectors are going to outperform or underperform. We're just not seeing that as of late. It's again relatively flat. Now, what has the SEAF model done? The SEAF model has been a relative performer over the last couple of years, doing a good job of sticking with the market, taking what the market is giving us. Again, the SEAF model has identified the top outperforming sector the last 8 years that we've been tracking. So it's still doing a good job of getting there. But I think with the fact that we're seeing a lot of indecision and craziness out of Washington, it's causing investors to not be willing to get off sides, because taking an outsized bet on a particular sector right now could lead to an overnight tweet that puts you in a bad position that has nothing to do with the fundamentals, has nothing to do with the trends, but very much a governmental control over what sectors are performing versus what sectors are not. Again, leading into our sector AUM, showing positive, which means we still have some room to run in terms of how the S&P 500 is doing, nearing fresh all-time highs as it has been over the last couple of weeks. Seeing this nice positive trend coming up over the 21-day moving average. So things are still looking good for the overall market, but just wanted to try to give a little bit more of a deep dive into understanding how do we have these sectors, and we've seen it really over the last year, that go from the bottom to the top in a week. Again, partially that's math, and part of that is to do with really kind of some instability that we're seeing coming out of Washington. Again, not a political statement, just putting some rationale to the numbers that we're seeing. Rainbow charts. Energy is looking strong, sitting in that upper favor, got this nice spike in relative outperformance, really kind of broken out of this box that we were going back to July. So seeing some really nice positive things out of energy. This one seems to be sticking a little bit more. We're seeing a little bit more accumulation over a period of time in the assets under management for energy. We're not seeing that quick retracement back into a void and picking up a little bit of accumulation. So things are looking good for energy. Healthcare. Healthcare is looking relatively positive. We don't have that stark upward movement in the relative outperformance versus SPY that we're seeing in energy, but healthcare is looking nice and strong, spending a little bit more time in favor as of late, and having a nice positive trend that's going back to September of 2025. So healthcare continues to be a good place to be. And then wanted to bring up technology. Technology has been sitting in a void for a little bit now. We made a little bit of a move to try to get into neutral. That was rejected. We're sitting sideways to down going back to October of last year. We've been seeing this in some of our relative outperformance charts. Mags has been underperforming the S&P 500 going back for a little bit now. Where we saw this giant run up in big tech, a lot of it, really centered around AI. There's been some cracking in that bubble here. It's not popped, but we're starting to see, companies come out with as they're rotating money throughout the different tech companies. There's some, speculations in the fundamentals that valuations for AI are significantly higher than they should be relative to the output that they're getting, and just some overall concerns over, energy prices and things of that nature, and what some of these AI systems bring to the overall market. So what is this? This is not about a bubble burst, but more of a apprehension on the upward target of where technology can go. And a lot of these technology companies that, even if they weren't AI companies, kind of hitched their wagon to the AI trend. Technology not a good place to be. That is all I have for this week. I look forward to breaking down the SEAF model with you all next week. And feel free to shoot me any questions. I like talking about this stuff, and I know we're kind of in a unique situation when it comes to trying to understand what this model is doing and why it's acting the way it's acting. Like I said, these two charts are kind of really the main focus here for me. We have assets coming in, but they're coming in proportional. So investors currently aren't taking outsized bets on any one particular sector. But the cool thing about SEAF is, that we do this weekly rebalance. So as soon as there's a new trend and money starts to flow in one particular sector, the SEAF model is going to catch up. Thanks, everyone.